Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm really excited to have with us Rachel Lin, who is the co-founder and CEO of SynFutures, which is a decentralized derivatives trading platform. Rachel's also held senior roles and was a founding partner at Matrix Board, before that Bitmain, Alipay, Deutsche Bank. So she has a fascinating view of the transition from traditional finance into the edge of innovation in our industry. With that, Rachel, welcome to the conversation.
Thanks for having me. It's a pleasure to be here.
Fantastic. Let's start with finance and what pulled you into the financial services industry. What were some of the first things that you worked on?
I started my career with Deutsche Bank, as you mentioned, in their structured derivative sales and trading departments. If you ask me about why I joined finance, I have to honestly admit that at the time, it was so cool for graduates to join a high-esteemed global investment bank. And I watched all those movies about Wall Street and fascinated by the speeds. And I would admittedly say that, part of this is also coming from the glamorous looking of the whole industry at that time. And although that, yes, soon after a few years, I realized that there's an emptiness, if you say that. And being young professionals, as many other young professionals feel, I started to switch my career path. Yeah.
What is it that you did at Deutsche Bank, and what geography were you in?
I was basically in structured derivative sales and traders back then. At that time, I was serving clients of a large corporate in the Asian market. So the daily job mostly involved identifies different clients' risk profile and structures derivative products. At that time, it was complex derivative products that's yet not seen in the crypto market yet now, like lots of combinations of options, index, and explains to the professionals, and then later execute a trade if it's not what we call plain vanilla product. This is in a plain spot market, or we'll pass it to the structured traders of a specialized DEX within Deutsche Bank. So that's what I was doing back then.
I'm very curious about the demand side of derivatives, and especially in the Asian market. What kinds of corporates were you interacting with, and why did they need derivatives? What were they using it for? And just curious about the types of products that were the most popular.
I would say that for a very short period of time, I also trade with some of the hedge funds and private banks. And for them, most, let's say, more speculative products, they would love to earn a higher yield. Say for today's rates environment, if there's 5% on a US Treasury bill, but if you sort of build an element of optionality into it, and you'll get a much higher return if your view proved to be correct. Say, for example, if Bitcoin goes within certain range, and you benefit from your view and get a much higher return. So that groups of sort of clients, let's call them speculators. And the other part of the group is, which is a larger group for the Asian markets, let's call them hedgers, because traditionally Asians being large exports countries, so many local corporates export their goods into Euro, US, and they receive dollar or euro at that time, but their spending currencies is local, Korean won or Hong Kee or Chinese CNH. So they would use derivative to hedge their positions. They will lock in the exchange rate, say from the starting from the year or from the starting point of the export contracts. for them to be, shell away from the FX rate volatility. That's another type of sub-client. And the last group definitely is the arbitragers. I seldom talk to them, but arbitragers are those people who really, you say there is a different price within a 3 months maturing contract and a 6 month maturing contract over the spots. So they could buy one, let's say long, and short the other tenors. For example, these are the typical applications. So speculators, hedgers, and arbitragers are the most, large groups for the derivative users.
It's notable that this foundational experience for you showed some players who had very economic reasons to engage with derivatives, to hedge exposure for imports, exports, and lock in FX rates. And then also the speculators and arbitrageurs in the market who were really there for financial reasons and taking advantage of the market structure. If you were to guess at a split in the traditional markets, even in sort of really high growth areas like Asia, if you were to guess at the split between those economic use cases for FX hedging and protecting your business versus finding ways to make money, what would be your guess for the proportion between them?
In fact, at that time, I would say a larger portion might be, for a true part, right? If it is a complicated, complex derivative, when we talk about complex, it's like another degree than today's life. Futures and simple option is a combination of them. Then, interesting, most of them came from hedging purpose. The reason being that I started my career after the '08 financial crisis. And so for every global bank to really transact with their counterparty, they need a strong underlying and reasons for that. Otherwise, your trade wouldn't even get passed at that time, internal approval. That might be due to the reason that there were too much speculations, and turns out that those clients don't have real underlying needs for that, and then they default, right? So that is for the complex products. But for simple options and futures, I would say speculations and arbitragers having a larger pie.
So let's move towards your tech experience and Alipay. What was that transition like, and what were some of the cultural differences that you saw?
As I just now briefly mentioned that after a few years with a global investment bank, you kind of feel like you're doing something that's not really, let's put it, contributing to the society, if you say that a lot, right? Although you are earning a very high pay and look nice, dress nice, but since I was with a complex derivative team at that time, I didn't see much needs, much real reason for clients to use this. It just complicated the stuff and let the banks have more opportunity to charge you more, right? So at the time, I was so drawn to the ideas of, I'm not sure whether you heard about microfinance at the time and fintech, and the slogans of making money while saving the world was so intriguing. That's the reason why I took a not so common move at that time and moved to Alipay, a fintech company. I think that I learned so much within Alipay. In that, number one, it's more like a startup, even though today you look at it, it's a larger company. You really learn how to build the products and drive huge growth from zero, from scratch. That's number one. And secondly, I think at Alipay that time, it really gave me the exposures to, I talked to various different startups from different categories in the world, and finally helped lead me to the positions within Alipay to let the first versions of blockchain's platform. And it was that experience that's so transformative for myself. Immediately helped me to make the decisions to move to the crypto space. Yeah.
Interesting. So, Alipay is bigger than Deutsche Bank, right?
Yeah. Yeah. But I mean, when I joined, it just established. So yeah, later on, somehow it was big, it grows to be a bigger company than Deutsche. Yeah.
People still might think of Google or, Facebook and Meta or TikTok as like these tech startup firms, but they are in fact like 10 times bigger than any investment bank. And if Apple wanted to buy, JP Morgan and Goldman Sachs and Deutsche Bank and Credit Suisse, they just could.
Yeah, definitely.
There's also a big difference in terms of customer reach, going from a very institutional business with large corporates to businesses that are, I think, much more retail and focused on bigger footprints. Can you talk about that in the context of Chinese fintech as well as the Chinese cryptocurrency industry?
For one thing, unfortunately, like Alipay I was doing global business as well. Customers are not really local Chinese, but mostly I think like we were at Asian markets, including like Hong Kong, Thailand, Korea, and other Asian markets. But definitely like for the Asian markets, I kind of feel like the clientele about those fintech company are mostly different than today's crypto. Let's divide the customer base into three groups. I mean, the first group, let's call them institutions and very high net worth persons and family office. These are the types of clients that like Deutsche Bank and other global large bank is after. And the experience is just like anywhere else in the banks that you have a huge team supporting just one client from there. I mean, like we have our salesperson, relationship managers to, I mean, like even dedicated operation person just for one single client. And there were not so many clients for those large because the entry barrier is so high. And for the fintech period, so for, say, for example, for Alipay, we built the blockchain services to enable instant cross-border remittance for Filipino who were in Hong Kong to send their money back to Philippines, right? And other spaces. These are the other groups of users. For finance that is really long tail, and then they can't even open bank accounts in many jurisdictions. And for them, it's very simple. Like one, easy to use. And secondly, you offer real benefit to them. And thirdly, you get some incentive to tap into the markets. And then you would win many of your clients back then. But I would say that for crypto, sort of like they were in a different clientele. It's like relatively high net worth person and really relatively smaller institutions in the global finance states are the major users for crypto nowadays. And as far as I know, because interestingly, I mean, both China, Korea, Hong Kong, and Singapore, and any other like jurisdictions that I travel to and talk to, today's most people still view it as a way to grow their wealth. So the very direct approach for them is that really come over here and then see whether there's anything interesting out there that could grow your wealth. I mean, for the vast audience. But after that, after the hype, you really drawn a group of idealistic people would love to explore the other opportunity and the futures of finance out there. After that, you saw real like daily users from each of the jurisdictions in Asia. I would say that, yes, I mean, if you compare to Euro and US, that many of them come from very care about the tech itself at the very first place. For Asia, they were moved by the story and behind them at first. I think that might be like due to the different culture between the different groups of people. Yeah.
Moving on in terms of your career and your development, can you talk about what led you into Matrix Sport to become a founder, and what kind of trends that you saw that gave you confidence that the sector was going to grow?
As I just now mentioned, in Alipay, I started to learn about blockchain and the first versions of blockchain platform. But for myself, I kind of found the difficulties in building the consortiums, or let's say permissioned blockchains within a large enterprise. But the ideas of blockchain fascinated myself so much that I decided to join a project that is dedicated to the public blockchains and permissionless blockchain, because that's where I feel where the future should really be. And that's why I left and later on joined Bitman and Matrix Ports. So at Matrix Port, I was one of the founding partners and who led their efforts on the lending, margin trading, as well as DeFi, wealth management. But my interest has been always in the, let's say, real Web3 stuff and to build something on top of a real public blockchains. But although Matrixport has been doing well, it's a centralized platforms. And that's also the reason why I left Matrixport and later on started my journey with SynFutures. It's a completely decentralized derivative platform.
Got it. Okay, so tell us about SynFutures. What is it and how does it work?
Sure. SynFutures is a decentralized derivative protocols that's very much like the ideas of Amazon, where anyone could lease and trade anything in 30 seconds. So if you love to have a fintech blueprint like a subscription number versus USDC trading pairs, you could do so by simply supplies USDC into our protocols and create a pair within two click. It has been doing very well for the past few years. We were number one on Polygons and even pre-tokens with over 20 billion trading volumes. And that's also thanks to our communities as well as our backers from like Pantera, Polychain, Dragonfly, Framework, Standard Cryptos, among others.
Maybe we can pause on the word decentralized, right? Because you've had these experiences with custodial providers of both fintech payments as well as digital asset neobank with Matrixport. And those have grown very well, and they've got lots of convenience features around people managing money on your behalf. Why build a decentralized service? And maybe what is the distinction between a custodial service and the one that you're working on now?
For a custodial services, a very good example is the one that everyone knows, FTX, right? So you put your money into the hands of a centralized service providers without knowing what happens to your assets, without knowing the fact that the centralized provider might take your assets and use it anywhere else. But in decentralized, definitely you have the transparencies and know exactly where your assets are going to. So that's totally different model. But what interested me most is not only these transparencies, but also let's say the trust list that lead to a completely new paradigms of service offering. We know that in Web2, right, the internet revolutes the information provisions by creating all those like different platform like Amazon's and Google's, but it's just information. You can't really punish a person if they say something bad on internet. But with the blockchain, you could really like offer a permissionless market on assets and immediately, have the governance with the token there, because like out there's token is the assets and the code there is the asset itself. So in a decentralized platform like us and many other decentralized platforms, you were able to really offer the markets with assets, just like the Amazon one, right? And then like the code would help you do everything from market makings to P&L calculations to settlements and managing the different pairs, assets, risks according to the rule out there. those service providers in the past that were dominated by all those large hedge funds, etc., are now open up to everyone. So everyone could become a market makers and everyone could become a service providers and provide their idle liquidity in decentralized world. To me, this is fascinating because, for every person who ever work in the finance, to really utilize idle liquidity across the world and offer the benefits of using all those liquidity to everyone is something so ideal for the finance world. Yeah.
Can you talk a little bit about how a synthetic derivative protocol works on, Polygon or any other network? In particular, you mentioned 20 billion in terms of cumulative volume, while, the value locked that's necessary to anchor the protocol is much lower. Like, what's the mechanism? What's the machine that allows such large notional to be traded?
For derivative like us, first of all, it doesn't require you to have like two different assets to supply liquidity into the protocol. You can only supply one, say USDC, into the protocols, and the protocol would help you create let's call it a synthetic long positions of the other asset. For example, let's say ETH and USDC, right? You supply USDC, and then you could view that part of your USDC is used as margin to create a position for ETH. You synthetic buy another positions out there, because for derivative it's unlike sports. That's Apple for pairs. You settle the difference in USDC, and that's fine. Say if you buy an ETH, long ETH positions, and when ETH goes up, you could settle the difference in USDC, right? And that does not require you to have the ETH. That's number one. And secondly, for our visual models, leverage could be applied to that, which means that you just supply a very limited amount of assets into the protocols for small range, and the amplifier will work within themselves. We have calculations out there with our smallest chain range. The capital efficiency is over 25,000 times than a normal sports, which means that 1 million could equals to 25,000 million, right? That's from the derivatives accents perspective.
Do you mind clarifying that again? So is that 20 times, is that like a leverage, or how should I think about that?
Yeah, you could think about it as twofold. One is that from Uniswap, right? V3, you could provide a liquidity within certain range. And secondly, there is this leverage portion into that. Say if you trade similar, it might be easier for you to think about a trade, right? With spot, if you like to trade $1,000, you need $1,000 at hand. But with derivative, you could supply just 100 USDC as the margins and get the amplifying effect to trade 1,000. That's the leverage. So there are twofold into that.
Yeah. How do you manage the net exposures? Or let's say lots of people put on levered bets and win. Where does that capital come from for them to cash out?
For our latest model, they were twofold. One is that there is this limit order functionality out there that is CFI compatible. For you to cash out, normally it came from for our model, right? It came from two parts. One is that you make a trade, and the other, if you're long, right, and some people come and take the other side, then your position cross out. So this is similar to a centralized exchange. For you to trade with Coinbase derivative or Binance derivative, the reason you are able to cash out it is because that there is another order who could just took the opposite directions of your trade. So that's the limit orders. And for us, there is also this AMM. So if at that time the limit orders or the order book is not taking the other side of your trade, our AMM would also took act as your counterparty to the other side of your trade. So basically, you'll be trading against two groups of people in our model. One is that your counterparties who make the trade, and the other is definitely the AMM. Yeah.
So to play it back, it's, either there's somebody on the other side of the trade, and in the investment banking case, a company might need to do hedging or put on a complex derivative, and the investment bank would take the other side, but then hedge it out in lots of other places. In the retail context, you might have somebody just taking the opposite position, but then if somebody's not taking the opposite position, you might be using the underlying LP or value locked in the smart contract that is providing liquidity.
Yeah, that's mostly correct. For investment bank, there's a slight difference in that your counterparty most likely is the bank themselves. So if you take a trade, if you're trading with a bank, right? There are two types of counterparty you have. One with an exchange. Then with an exchange, like CME and others, it works as what I just described. But with a bank, like most likely the bank would have a DEX who act as your counterparty. So what they did is that they're similar to AMM, right? So some client come and buy and some other client sell, so they would net off the positions. So they will manage the rest of the what we call is risk. So they will break down your instruments into very simple risk profile, and then there is a tolerate level within bank themselves that up to $1 million positions, I would not hedge in the market. So for that $1 million positions, or let's call them risk positions, they might keep it in the book or they might hedge out immediately. So the hedging parts and the trading parts within the bank's books could be different. Not exactly the same. So that's the reason why you need to transact with a large bank. Otherwise, the bank will go bankrupt and you don't have a counterparty.
So what happens in the case of the AMM, if there's not sufficient liquidity provided to the AMM? Is it that the trader in the first place wouldn't be able to put on a position in your protocol, or how does that edge case work?
Yes, you're right. We came from the investment banking world at the first place. So we design lots of risk rule out there. Say we have a limit on the positions that you will be able to open. So if we don't have, so your position wouldn't be able to increase the net positions of the AMM through a certain portions of the AMM portfolio in total. So what we look at is the net increase. Say if you have a long and a short, like as a client, then that's fine. But if your trade add into their increased positions of one side, and then we have to limit your trade positions to a certain level, not exceeding portions of the AMM. Yeah. Otherwise, you wouldn't be able to close. But yes, there is an emergency rule out there is that if all of a sudden the AML will draw out, and you might go into an emergency mode to settle. But it's an edge case. Yeah, you're right.
How do you see the perpetuals or the synthetic derivatives sector, shaping up and evolving? And maybe what are some of the distinctions between the different protocols out there? There's, I think DYDX is having quite a bit of traction. There's, of course, synthetics, PERP protocol, SynFutures. How do you see the different players differentiating, and what are those avenues for competition coming up?
For us and for different like DeFi PERP, they did have different characteristics. Like, for example, DYDX, they were good in terms of performance, and I will respect them a lot in terms of the efforts that they help sort of educated the whole DeFi ecosystems. Although I would say there's a sort of like centralized elements in that like they were not deployed. At first they were using like a centralized service, like for order matching at the first place, and recently they've just been migrated to a Cosmo chain by DYDX itself. So instead of being in the other like common Ethereum and layer 2, the strength of that is definitely higher efficiencies as well as the speeds. But versus us SynFutures, because it ran more like a centralized exchange business, although in a more transparent way, it still require a lot and a lot of efforts for them to support each trading pairs. So for them, it's purely an order book function. So in order to list any products, they have to find the market makers. They have to do a lot of configurations and on this. I would build decentralized model more like, let's say, a high-end store. Right, the stores and the high-end store have to decide what types of brands and what types of goods were able to be listed there for sale. But for us, we're more like an Amazon model. So anyone could come over here and list out your favorite derivative in one go. And we combine the limit order and the order book together into one single models, which help us to enable the C5 compatible capital efficiency as well as the permissionless natures in derivative. Although the shortfall is this, because we insist on building all these on-chains, the efficiencies might depend on the underlying chain, for everyone. So that's the radix sinners. And synthetic, I'm sure that it's against the pool, and like GMX, you are not really trading, GMX is not really trading against a counterparty, but trading against, let's call them a fund, right? It's your counterparty is the person who just puts the fund there for you to borrow and to trade. So it's a different models. But I would say until today, DeFi derivatives, in its very early stage, it hasn't took flight at all. If you compare with the traditional markets, derivative often took up a much larger portion in terms of volume versus sports. And even in crypto centralized exchange, derivative trading volume is much larger than sports already for top exchanges. But I look at the data for last year's, DeFi derivative only composed about 1% of the total trading volume in crypto. So there was still very huge room to grow. Yeah.
Absolutely. So I want to go to the question that I had for you in Deutsche Bank, which is, the split between speculation and arbitrage and economic activity. I think I know the answer, but I'm curious. Maybe I'll be surprised. Do you see any economic usage of the crypto derivatives markets, or is it all at this point kind of financial investment?
I would say most of them are financial investment, and if you want to use the word speculation, that's fine. Yeah, and there were some elements of hedging I saw, and some elements of arbitrage that I saw as well. Hedging came from the miners, right? And they were mining like Bitcoin. As far as I know, some miners do use derivatives to hedge their outputs of Bitcoins. That's for one. And for arbitragers, they are taking a larger portion than their hedgers in terms of derivative, because there are some, let's say, professionals out there that they will arbitrage between centralized and decentralized exchanges, and also across different exchanges, as well as across spot and pubs. But I'll honestly say that the larger usage derivatives still come from speculators. That's true, and that's fine. Be patient, because I do feel at one time I was also very confused and trying to see what is the real applications of blockchain. Right? I'm sure that you have to answer. Everyone's been saying that blockchain will revolutionize the finance, and why is it that we didn't see large application in the real world besides investment and speculations? But at one point that I came to realize that maybe it's not that the application is not there, but because the economics haven't went to a stage where digital economics took out most of our daily life, right? So with the growth of the digital economies, and I think that the usage of blockchains will grow, and at that time, derivative will definitely grow as well for the use case of hedging. Yeah.
It's a question I look at a lot. When I was at Consensus, we would want to hedge our ETH exposure, but doing it at a regular broker like a Galaxy or a Genesis, prohibitively expensive, where you could be paying $1 million to protect yourself for 3 months. So it never worked. But there is an economic use cases for, I think, DAOs with treasuries to deploy. And then on the follow-up on the economic question, one of my theses is that blockchain is for robots, and we're going to see more and more robots for sure over time. I think this has been an absolutely fascinating discussion. Thank you for opening up these topics. If our listeners want to learn more about you or about SynFutures, where should they go?
Thanks for the opportunity. Yeah, definitely visit www.SynFutures. That's SynFutures.com. And you'll find everything there from our DApp to our social links. Yeah.
Fantastic. Rachel, thank you so much for joining me today.
Thank you so much.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.